So good afternoon, everybody. I hope we're doing fine out there. Um, Let me start sharing my screen here and we will get going. Okay, I gotta hit the right button. So now let me get to our screen here first. Good afternoon, everybody. We are now on week 8 lecture discussion, October 13th and 15th. So we should be good to go here. Everything that we need for this class is up here. So I have already pulled down our lecture notes for week 8. Week 8 bonds, XLS, we'll be referring to. And the homework 6 key we'll be talking about as we're moving through this as well. So all of those materials you might want to, if you haven't done so already, download those and have those on your computer. I'm now going to go to our class outline. Here is what we're looking at today. And first off, we had asset tracking. And again, our outline today is asset tracking first. Homework 2 we'll do. And then we will come back and do some more bond pricing material. So let me start here with with our asset tracking. And last week our S&P 500 went from 33.48 down to up to 34.77, an increase of 3.84%. Treasury note, 0% change on 1 month. The 1 year note went up 25, or the yield on the 1 year note went up 25%, and the 10-year note went up 12.86%. So we had some pretty large increases on those yields, percentage-wise. But from the standpoint of yields themselves, the 10-year note, to get that 12.87% increase, went from 0.7 to 0.79. To get that 25% increase, we went from 0.2 to 0.12 to 0.15. So there's not really a lot of changes there. Or, you know, if from an overall standpoint, they didn't change a lot. So let me, and I lost my, oops, let me get back here. Got a question. Type what you all found as your news this week, or what did you put in your news this week? And I'm looking for my chat now. There it is. So if you wouldn't mind, just tell me what you put for your news impacting the market this week. So take some minutes and type it in the chat, and I'll put some notes up here. All right, impacting returns. Yep, stocks went up due to optimism from Corona relief bill. Stocks went up due to, that's right, optimism optimism, if I can spell it, about y'all mentioned the same thing. Well, and that was in the news. The coronavirus up because of coronavirus. Cam mentioned the stimulus standoff, which is related to the coronavirus. Yufan mentioned the stimulus again, and tech stocks did go up. We're getting some feedback from somebody here. So, yeah, so we're still looking at the same things that we did in the beginning of the quarter, or the beginning of the semester here. But again, the news centered around stocks went up due to optimism about coronavirus, stimulus standoff, stimulus in general. We've had some discussion of the stimulus package this week, and tech stocks did go up this week again. Some likely because of the 3.8% increase went down. Yeah, that's true as well. The pace of dividend cuts by companies declined. It's sort of interesting, or from my standpoint, it is interesting. Pace of dividend declines. In the S&P. It's sort of interesting from my standpoint at this point in time, the difference in performance by across sectors. We've seen sectors, the tech sectors do extremely well, both from a market change standpoint and also from an income standpoint. My guess is Amazon is going to have one of its best income years, and as well as a number of those other tech stocks because of the COVID-19 control measures and what that has done shifted our spending habits. On the other hand, we have some companies like any travel company, passenger cruises would be one of the worst, having their worst year and then wondering about what that's going to look like in the future. And then there's something in the intermediate area, such as Exxon Mobil and some of the fuel companies that are seeing incomes go down, but still having a product that people need. So it's an interesting time. So I want to focus here, since we're talking on bonds. All right, I am going to go to an illustration of bond price for different year to maturities. All right, and you see this graph here. This graph was created in an Excel spreadsheet that you have available to you. It is called the sheet is called Week 8 Bonds. So that's where you'll find that. Oops, now I managed to. And I'm going to blow this up here. And I'm going to zoom this up. And I want to show you how I created the bond, this graph. Here's the graph. And what it does, this is a 10-year note right here, and it gives the bond price for different yield to maturities. So right here we're at 0.25. We have this bond price, and here at 10% yield to maturity, we have this price. These are all calculated within this worksheet, and let me show you how we did this. At the top, we have a 10-year bond and a 1-year bond. So I laid out 20 semi-annual periods going for the next 10 years. The 1-year bill has, as is the case, the tradition, or the convention, only has a par payment at the end. I'm using $1,000 par. So in 1 year or 2 periods, it gets $1,000 payment. And here are my payments for a 10-year note. To lay out the payments for a 10-year note, you have to assume a coupon payment rate. And I'm using a 2% coupon payment here. If I changed that coupon payment, made it higher, my bond price would go up. Made it lower, my bond price would go down because there would be more payments in the middle of it. I set up my discount factor, given a yield to maturity here. I have a yield to maturity of 0.01. Come up with these discount factors, and it's a, oops, sorry about that. View, how did I get, what did I hit?
Maybe the print view, I don't know how to.
How did I get there? Oh, normal, there's my normal. I'm sorry. All right, so here's my discount factor for period 1, period 2. And so my discount factors are becoming lower as I go forward in time because it's forward in time and I'm discounting. Then over here, I just multiplied my cash flows by my discount factors to come up with the discounted cash flow, and here's the bond price here. So that's the process. Okay. And then I created a table, and this table varies this yield to maturity. So, oops, oh, I can't change my table, but if I put, let me hit escape here, oops. If I hit 0.0025 here, I will get my bond price associated with 0.025 here. As you see, change it to 0.05, 005, oops, 0.005. You'll see that I get my bond price associated with that 0.005% yield for both my 1 year and 10-year notes. And then I graphed them here. All right, I want you to notice something about those bond prices. If I go from 0.25 to 0.5, the 10-year note has a much larger, going from 0.25 to 0.5, it has a much larger impact on my note bond price. In fact, I can calculate it here. 0.25 to 0.5 is a 0.002% change, 0.2%. Let me just put it in percentage while I'm at it. 0.25% for my 10-year note, it's minus 2.27. All right. What explains that? Why is my 10-year note having more of an impact on the bond price? Think about it a little bit. Why is my 10-year note having more of an impact on my 10-year note than on my 1-year note? The answer is that these further in the future discount cash flows are getting discounted much heavier. All right, if I go from 0.05, so watch this, 0.005 is 960, and this, if I go back, 985. So, and it's just a mathematical relationship, I change my discount factor, and I'm taking it to the 20th power. All right. So, and let's go back to duration. Which bonds are more sensitive to bond price changes? And the answer is those bonds that have the higher duration. All right. All right. Those bonds that have the higher duration. If I am concerned about yield price changes, let's say I'm concerned that they're going to go up. Actually, if prices go up, my bond price goes down. So if I had the choice, if I believe that bond prices are going up, bond prices are going up, would I hold if I had a choice, 1-year bill or a 10-year note? Which one would I hold? If I had to hold one of those two, I would hold a 1-year note because it's much less sensitive to bond price changes and its bond price will go down less. Okay. All right. So the longer you hold the bond, the more risks you have relative to yield changes. Again, it's just a matter that we're discounting those or taking them to a power the further out we go. And again, you see this relationship right here. This 1-year note has a much less price changes over this broad range than this 10-year note. All right, so that is the illustration of that bond price change, and we will come back to that later. All right, I got a question. I'm doing a poll today, and I'm just curious. This is just my curiosity. Tell me where you're at. I am just curious. We got 2 more to answer. 1 more. All right, here's what you all said. Can you see the poll, by the way? Poll results. I'm just curious.
No, yeah, everything.
Okay, we can. 78% of you are in Urbana-Champaign. 22% of you are away from Urbana-Champaign. And I was just curious. It's good that you're here. Welcome here. By the way, if you ever want to stop by our class on Tuesdays from 1:30 to 3, we cover the same things that we do in this Zoom session that we do there, and you are more than invited to come to that session. So I will appreciate you answering my poll. And now I am going to stop sharing my screen, and Enrique, please take over with the homework.
Yeah, so let me share my screen here. Making sure that I'm doing that. Yep. Can you guys see my screen here? Someone type yes in the chat box. Yeah, okay. Yeah, so I'm gonna go over homework 6. If you have any questions, feel free to type in the chat or interrupt me. And a heads up here on question 4, I'm gonna go over it, but we're gonna waive it because it was missing a piece of information, kind of. So I'm gonna go over it anyway. So feel free to interrupt me. So for question 1, we ask you to calculate the forward rates given the spot rate, right? And to do that, you should be able to use that formula that relates the forward rate with the spot rate. It is found on the chapter 7 here, or the structure of rates here, page 14. So remember that the first forward rate always equals the first spot rate. Now the second onward, what we're going to do is plug in that formula. So just be careful because there are two parentheses kind of, or three actually, right? So 1 plus the spot rate of this period n divided by 2, that's what we have here, raised to n. And you could have type 1 or 2, sorry, but ideally you would link it here because then you can drag the formula down. Divided by 1 plus the spot rate on the previous period, n minus 1, divided by 2. And then this raised to the previous period, n minus 1, which is, in this case, is equal to 1. Close parenthesis on that over here. Take 1 minus 1, close parenthesis, and do times 2, okay? By doing that, if you did the formula like I did, you should be able to drag that down or double click it all the way down, and you would see so everything filled here. And we ask you what kind of yield curve is exhibited here. So it goes down a little bit here on this first 5 periods, but then it increases. You should be able to see that if you graphed that, you see that you would see some ups and downs, but overall it was increasing, and so it shows a positive here yield curve and a typical pattern. Okay, I think Gary's gonna graph that later maybe to talk about it. Okay, so that was question 1 and 2. Now for question 3, it is pretty much like we did on the last homework. So we gave you a $10,000 or $1,000 par bond with a 2% coupon rate, and ask you to calculate the yield to maturity, right, for this 4-year bond. First thing that you're always going to be doing is figuring out this the cash flows, the future cash flows that you're going to be getting. So from period 1 to 7, you're going to get the coupon rate. Remember to divide the coupon rate by 2 because those are semi-annual periods. So you're getting $10, and on the very last one, you gain the coupon rate again, the $10 plus the par value. So on the very last one, you're going to have 1,010. Now remember, the bond price equals the discounted cash flows, or the discounted cash flows that you're going to be getting from it. So to do that, you would discount those cash flows to present value, and this will equal the bond price. To do that, each discount for the discount rate here, sorry, you can use the spot rate from questions 1 and 2, okay? And with that, you can calculate the discount factor for each period, okay? Then you should be able to multiply the cash flow by the discount factor, drag that down, and the bond price, I plugged it here, is just the sum, just the sum of the discounted cash flows. Now remember, okay, you're gonna say the bond price is equal to 1,070. Let me just zoom in a little bit, 1,070. But now we are asking for the yield to maturity. And remember the yield to maturity, what we did on question, I believe 3 on homework 5 or 6. Anyway, it's just the internal rate of return formula on the cash flows, right? So think on the cash flows as your pocket. On the very last or the very first period, you're paying the price of that bond. That's why it's a negative. Here's some of those cash flows. So you're paying that for the bond. So you have cash outflows, and then from period 1 to 8, you have cash inflows. If you run the internal rate of return formula here on those cash flows, you would get, let me put that on a percentage, 0.12%. But remember, if you did like this, you're getting the internal rate of return on the semi-annual periods. So to make it annual, you just multiply that by 2 here. Okay. So yeah, 2.237% over here. Okay. So yeah, this is, so the only new thing, the only new thing about it right now is that since you didn't have the yield to maturity, you can use the spot rate, if you have it, of course, as the discount rate. Okay. If we gave you, let's say this is 0.237% here, you could use, instead of the spot rate, this yield to maturity to figure out the price. That will yield the same result. Okay. But now, because you were solving for that, you only had the spot rate to do that. Good. Now for question 4, we asked you this situation. You had 2 options, and our mistake, just getting ahead of time here, we actually, the table was just a half table, right? So if you did all the way to 16, perfect. That's what you should be doing. If you did it as 8, that's fine as well, right? Because it was our mistake. But the intuition should be the same. Okay, so you have first here option A, where you buy a 8-year principal strip bond. Remember, the principal strip bond is essentially you're getting a bond and you strip out just the principal, so you don't get any coupon payments on that. So it's essentially a 0 coupon rate bond. Okay. In option B, you have the option to buying a 4-year principal strip, and at year 5, you would collect the money and reinvest on another 4-year principal strip. Okay, so a 4-year no coupon rate payment bond. Okay, so that was the 2 options that we were trying to compare. Okay, so to do that, you have here the spot rates and the forward rate. You could have calculated that again, but you already did on question 1, so you could just reference as we did here. Okay, and we asked you what was the future value of those 2 options after on the end of year 8. Okay, so for option A, you could have filled it all the way. I did it as well. You could just like get the present value of that and multiply it for the spot rate times or raised here to the period in each period. So like you're just moving and getting the future value of that option in each period of time. Okay, if you did it just on the very last one, that's fine as well, right? So you're getting what is the future value of the bond on year 8. Okay, now that's why remember to divide the spot rate by 2, because you have semi-annual periods again, and raise it to the period here. Now for option B, essentially what would you be doing is you would do the same here until year 4 over here. Okay, so you could just delete those. So have the future value of the option B in year 4, right? So same thing, you're just getting the present value and taking it back to or forward to a future value using the spot rate divided by 2 raised to the period. But now at period 8 from 9 or 8 to 9, you actually you have some risk there, but we said that the curve won't change, right? But essentially you don't know the rate, the spot rate on year 9, right? So you would be using the forward rate in that case, and remember the forward rate, think on that as a 6-month 0 coupon bond, right? This is the yield to maturity of a 6-month coupon bond, 0 coupon bond. Okay, so that's why I'm getting here on period 9, for instance, I have my future value on the previous period. Imagine that I'm investing that at the forward rate for just 1 period or 6 months in the future, and I'm getting that. Now, I would keep doing that. So see that for this particular option, you always have to use the previous future value times 1 plus the forward rate divided by 2, and you're going to be rolling that, right? Because you actually don't know that. But you should find same value here after in the end. Okay, if you did halfway here, despite the calculation would be different, you would find those 1009 over here, same for both. And it is like this, right? Because you have this equilibrium that should hold. You cannot arbitrage by doing that, okay? So the way that you put that together doesn't matter. Now, you do have a risk here, which we said that the yield curve would be the same, right? Remain exactly as predicted. But in real life, you would have a risk from period 8 to 9 of the yield curve changing. And on period 9, you'll be getting different spot rate, okay? So yeah, that was the risk. We didn't ask, but should be able to get same results for A and B because the yield curve doesn't change, okay? The only difference here is you're going to be using the forward rate once you do the reinvestment, right? But again, because we had it like this, so there was period left out. We are gonna give you the question on the homework, but I hope you guys understood that because it's probably like a midterm question anyway. So be sure that you know how to do that, regardless of this homework being graded or not. Okay. Questions here on the homework or comments? All right. Gary, you want the screen back? Hello?
Sorry. Yeah, if you wouldn't mind, I turned myself off.
Okay.
So, okay, I'm going to start showing my screen again. Oops, cancel. Nope, we don't want to do that. All right. I want to start. I got the homework here. I want to go first. All right. So this, by the way, if you're looking at these spot rates, one of our modules had a link to the calculation of the yield curve giving the spot rates, and that is where this data comes from. I just want to show you what it looks like. All right, let me select that. I'm going to label this. So here are my yields. This is the yield curve. It happens to be a spot rate yield curve. All right. And this is what it was in, let me make sure I got this right. Yeah. This was what the yield curve was in August. So you see here the yield curve, and you'll notice that we had a little blip here, but overall it's an upward increasing yield curve, and then it just flattens out. All right, from that, you then implied these forward rates. So this forward rate right here is this 0.1 or 0.18% is from 0 to 1 period. Here it is from 1 to 2. So this is the implied rate that would exist from period 1 to 2. And I just I don't know if you plotted this, but you'll notice something here if you plot it. it sort of goes up nice here like you would expect, and then it begins to bounce around. What's happening here is that as we get further and further out, and this is a good illustration right here, 179, 180, and 181. 179 to 181, the spot rates remain the same, so the forward rate remains the same. We had a small increase here, and then it goes up to 0.03728, 3.728. What's going on there, actually what's going on here is we don't have enough decimal places here. If we had more decimal places, this would be much more smooth. But again, here's what this looks like in real life. It isn't sort of your nice little curve here, but it does give you a feel for what can happen in the practice. And when we have these very flat curves and they're not changing, well, then our forward rate's not going to change. But when it does, it sort of blips up some. So that's what's going on with that curve. I also want to come here to question 4, and I'm just going to give you one more example. So let's say you're sitting here now, period 0. By the way, these spot rates and these forward rates come from question 1. And I'm going to say you want to get some cash flow here to period 4. You know that you're going to need that cash flow, and you're going to invest $1,000 today, and you need it in period 4. Well, you could just go out and buy a 2-year strip. All right, and let me just put this on here. I'm just going to transpose this. Transpose. All right, now I just put those. So this is the spot rate for period 1, period 2, period 3, period 4. And if I buy a 2-year strip, invested $1,000 in it, I would have $1,002, cancel. I would have $1,002 in period 4. And I'd just take my spot rate and calculate my cash flow. I know that I'm going to divide it by 2, raise it to the 4th period, and there I have if I buy a 2-year strip, this is what I get. And this is certain. If I hold that bond for that period, I will get this, will have this future cash flow. All right. All right. The other way I could do this, and actually there's a number of ways I could do this, but I could buy a 1-year note, then reinvest, or excuse me, the 6-month note, reinvest, buy a 1-year note, and then reinvest, buy a 1.5-year note, reinvest, buy a 4, which I did down here. But I'm just going to take this example. I'm going to buy a 2-year strip, or 2-period strip, and hold it to period 2, and then I'm going to reinvest it in a 6-month twice. And these are the rates that the market is saying will exist for 6 months. For this 6-month period from 2 to 3, 1 year to a 1.5 years. So if I then reinvest this note, my expectation would be that I would get that. Oops. So that would be what it's worth at the end of period 3. Just find the future value, copy this over, and here's would be for the period 4. All right, here's what you'll note. They have, let me sit here a little bit. They have, and my computer is being slow here, but look at those, they're the same number. All right, they are the same number. If, and that's what what right now, what the yield curve is implying and is the forward rates, and the forward rates have to be such that you can make these investments either way and you get the same expected future cash flow. All right, here's the first item to note is that this future cash flow is not certain. All right, it's not certain, right? And now here's the question that I want you to think about. Which, oops, now I'm having trouble. Edit. All right, I want you to think about that those will vary if these forward rates change. When will I be worse off taking this route? And it deals with what these rates will be. Right now, I'm expecting them to be this. All right. When would using this series, when would that make me worse off relative to what these rates would look like? Higher or lower? Okay. And the answer is, if these rates go up, I'm better off doing this alternative, right? If I believe that in the future rates are going to go up, I would be better off not making as long of an investment and then reinvesting. Conversely, if rates or yields go down, I would be worse off, okay? So while these have the same expected future value, this one reintroduces the idea of reinvestment risk. I might not get those yields, and I might be better off or worse off with this alternative. And again, I would be better off if yields go up, and I would be worse off if yields go down. All right. So this is part of the game, if you will, in bond investing, is deciding when and how long to make those investments. And if you believe that yields are going to go up, you will invest in shorter maturity bonds. However, if you do that, you're giving up yield because typically the yield curve slopes up. So the shorter maturity bond you invest in, the lower the yield is that you're going to receive. But if yields are going to go up in the future, you would be better off with these shorter term bonds, and vice versa. If yields go down, you would be better off with this longer term bond. Okay, so that's some of the intuition and motives here. If you don't have any questions, I am going to close this out and move to some more ideas in our in our cash flow or in our outline. So I'm going to close this out. I'm going to close this one out. And I'm going to go, oops, to our bond illustration again. And if you look at our outline, I'm going to go to this example right here. It's on page, the second page of the outline. And it also happens to be in our week 8 bonds example. And I'm just going to go over this. Let me blow this up. All right, so I gave here 3 cash flows, okay? Or excuse me, 3 bonds. Bond 1 is a 6-month bond. Bond 2 is a year bond. Bond 3 is a 1.5-year bond, so it has 3 payments, 1, 2, and 3. And then I left open here this yield to maturity. All right, you can calculate the yield to maturity here on this bond by using the internal rate of return. I gave you the price here. So this bond has an internal rate of return of 2%. All right, so if I give you a yield to maturity, you can calculate the yield to maturity from a bond price and then look forward to these yield to maturities here. All right, what I am going to do now, if you look at this, I am going to put the yield to maturities here. So this is your typical, what you would observe as the yield curve. And then from this, you could also get the spot rates and the forward rates. And what you have to remember when you're doing this is, here are your formulas that relate the yield to maturity, spot rate, forward rates. And remember, if this is bond 3, all these formulas result in the same 1007.35 bond price. Have to. In equilibrium, they have to. All right, this is my yield to maturities. What are my spot rates? And so we could calculate the spot rates for period 1, 2, 3. The spot rate for period 1 is the yield to maturity, all right? Because it's a 0 coupon bond, so the spot rate is the yield to maturity. For the second bond, it's also a 0 coupon bond, so it will also equal the yield to maturity. And the third one is not a 0 coupon bond, but you can use this formula, and let me just draw a curve here, insert shape. You can use this formula right here to calculate the spot rate for period 3. And here's what you have to realize. Spot rate 1, you know that, 1%. Spot rate 2, you know, 0.15%. You know the bond price, minus or 1,007, and this should be 35, by the way, here. And you know everything here. I've plugged it in here, and you could find the spot rate 3. I did that down here. I did the calculations down here. And I came up with a and if you look at this down here, I'm just rearranging the terms here. And this percentage. And there you go. So you can calculate, and in this case, these are really close together. They are not exactly the same. If I go out far enough, they vary, but not by much. So just they do they do vary a bit. And again, just so you know, the spot rate and the yield to maturity in this case don't equal. And it's sort of, again, remember, this yield to maturity is a weighted average of the earlier ones. And this one, this third cash flow outweighs pretty much all the others. So that's why the yield to maturity and spot rate in this case are very close to one another. We could also find the forward rates, and you did this in your homework, and it's the same formula again. Raised to the 2. I made a bunch of errors in my formula. Let me correct those. And let me make sure that I got it right. -1. I'm just implementing the formula that we used last time. And there you go. All right. So as you're looking at this, our forward rate in the first period equals, we have a 1.5% spot rate. To get that spot rate, we have to have a fairly high forward rate, 2%, and then 3%. So again, this would be, given these yield to maturities, this would be our estimate of what the spot rate would look like, or would look like, and then the forward rate between period 1 and 2, 2 and 3. Okay. You'll have an opportunity to do that this week in a homework. So there you go. All right. So that's that. And let's me move down our list here. Any questions so far? And again, you're going to do some spot rate calculations and forward rate calculations in your homework. And it's important just to remember that when you see a yield curve, you know what you're going to be looking at based on that yield curve is a projection of what spot rates look like and also forward rates. A yield curve says what the market is thinking about in the future. All right, let's go to our last example here, and we got a bond fund from Vanguard. So and I want to show you this bond fund, and I want to make some just general comments about this bond fund. We're gonna begin to look at bond funds now more in detail. All right, so where we're going. So far, we've been talking about treasuries, which are zero default. There are three other items that determine the yield on bonds. One is the riskiness of the bond, which we will typically measure by by a credit rating. Will tell us something about the riskiness of the bond. We will also be concerned with whether it has tax deferment or and that's the case in the municipal bonds. And there are also cases where you have a TIP, a Treasury inflation protected security. All right. I'm going to just go here. This bond fund, Vanguard Long-Term Treasury Fund Investors Share. Let me tell you what it is, and I pulled it from a Vanguard list of funds, and I'm going to go there now. I'm going to go to this link here. And go there. All right, it's coming. It's coming slow today. All right. So this is a list of Vanguard mutual funds that you're looking at right now. And I'm going to go over here to you. So it starts with money market funds. We're now looking at bond funds. And as you're looking at these bond funds, you'll notice that there's...
Oh boy, where are you go?
A bond intermediate government bond fund, an inflation protected securities bond fund. So you're going down this list, and the one that I picked was this long-term treasury fund, which is VUSTX. That happens to be its symbol. So we're going to go look at that under Yahoo Finance. I want to make a point here, though. This fund had a 20.8% return year to date this year. 20.8%. So that's a very good return, right? So very good return on this fund. And we will talk about why that is. But let me just go to Yahoo Finance. And I'm going to go to I'm going to type in its ticker symbol. There it is, long-term finance. Oops. I missed it. VUSTX. There it is. And let me go to its profile. All right. First off, you'll see this fund. Here's the fund summary. This investment seeks to provide high and sustainable levels of current income, and it invests 80% of its assets in U.S. Treasury securities, which include bills, bonds, and notes issued by the U.S. Treasury. It is expected to maintain a dollar-weighted average maturity of 15 to 30 years. All right, so that's what gives it its long-term nature, 15 to 30 years. All right. So if we look at at Vanguard's intermediate fund, it would maintain a much lower average maturity, 15 to 30 years. And so that is giving you a feel for the maturity of that fund. All right, let's go over here to our Morningstar style box, and you'll notice Morningstar style box, and you'll notice here that there's credit quality and interest rate sensitivity. Okay, so the Morningstar box in this case is different than stocks, which had a different arrangement where you were looking at the size, the cap of the stock and whether it was income blend growth. Here we are looking at credit quality and interest rate sensitivity. Both of those say something about variability of yields and the yield itself in the future. And I'm just going to write this down right here. All right, as I am looking at this box right here, credit quality, here's what I expect. Higher credit quality have lower yields. Okay. The higher the credit quality, the lower the yield. And that relates to default risk. And by the way, the higher the credit quality means that I'm expecting it to default. The probability of it to default is less, as well as the cost of the default when it happens to be less. So credit quality. So this is high credit quality, and the credit quality ranges from treasury notes, which don't have default risks, to AAA bonds, which have a default risk but are very low, AA bonds, which have higher default risk and will have higher yield. The other one is, you'll see here, interest rate sensitivity. This is duration or maturity. Okay. Interest rate sensitivity or maturity. As we increase interest rate sensitivity, we increase the yield. All right. So as we increase the interest rate sensitivity, we're increasing the duration. So higher duration leads to more interest rate sensitivity, which leads to a higher yield. All right, so just let's write that relationship down. Higher duration means higher interest rate sensitivity. All right. Which then leads to higher yield. Okay. So that is our relationship. All right, so if you're looking at this bond fund, its credit quality is high. That would generally have, and it's the highest because any treasury will always be in this high box. So it is high, so that would lower its yield, but its interest rate sensitivity is high, which would increase its yield. Let me find its, the duration is on the holdings page, but it's, you can see 18.41, which means that on average, its payments are 18.41 years in the future. So very far into the future. All right. So now, if I want higher yields, I could take a higher duration bond, but then I am looking at a bond that has more risk due to interest rate sensitivity in the future. Okay. All right. One more thing here. And let's go to the Vanguard 500 list, and I want you to show you something. And we're gonna specifically look at the returns. All right, this is return. This is what has actually happened. Yields are what is projected to happen. All right, there is a difference. Returns are what actually happened. Yields are the projection moving forward. And let me just look at these returns, and I want to pick three of those. I'm going to intermediate term treasury. And this one has a symbol of VFITX. We have looked at the long term treasury, which I now have lost in my list. Long-term treasury, there it is. VUSTX, so this is intermediate. This is long-term treasury. And there's also a short-term treasury. All right. And that happens to be VFISX. All right. If I go to this page, so here, my long-term treasury has a duration of 18.43. Let me show you what VFITX. This is the intermediate term. Its holdings, it has a duration of 5.06, much shorter. And then the short-term treasury has a term of, or have us a duration of 2.14. All right. So this is my treasuries. This is my duration. And year to date, and remember what year to date we're looking at, year to date. And I'm going back here. Year to date, this is as of 10/4/20, so this would be from Jan 1/1/20 to 10/14/20, and now here's our yields for these bonds, or excuse me, returns for these bonds. Short term has 3.75. Okay. So its return this year is 3.75. The intermediate term is 8.31. Okay, so it had an 8.31% return. And the long term had 20.80. So this is the returns for these three funds, all right? This year, this is the duration for this year. This is the year-to-date return for this year. All right. Now here, if you're looking at this, you will note this long-term treasury had an exceptionally good return, right? 20.80. All right, very good. Intermediate term had a good return, 8.31. Short term has 3.75. All right, what happened this year that these are all positive, and the longer the duration you have a higher rate of return, is this year rates have fallen, right? This year rates fell. And I'll just give you an illustration of that. If you look at the 10-year treasury, which you're following, 10-year treasury, all right? And you're following that. Here is what it's done this year. All right. Yeah, this is the last several years, but look right here, boom. This was what it was at 2021. This is a 10-year note. Yeah. Beginning year 1.83, then it's down here 0.84. So these all fell roughly at the end of February, early March, when coronavirus became very much evident. So we had a fall. All right. Which bond prices react more to rate changes? Longer term bonds. So this is why we had this event right here. And this goes right back to our first illustration. Bond prices that are longer term have higher impacts on or bonds that have higher durations. There's more of an impact on its price when yields fall and increase, but rates change. This year, rates fell, prices rose. We had a capital gain. It rose the most for long-term treasuries, all right? Intermediate term treasuries had less of a capital gain because of the rate increase than did long-term, and short-term had less. That's why you see that. Now it would work in the reverse too. Let's say we have rate increases next year. There will be capital losses and the long-term treasury will suffer the most because of that. So that is the risk associated with holding longer duration bonds, all right, versus shorter duration. When rates are falling, you want to hold long duration. When rates are increasing, you would want to hold the shorter duration bonds. All right. So if you have no questions, you'll have a homework, modules, asset tracking, same routine. So there you go. So we'll see you next week. You all have a good week.
Professor, I had a quick question.
Sure.
So when you were talking about the last part where long-term bonds would increase if the rate went down, and how long-term bonds would decrease if rates went up, and so it's always like in the opposite direction then?
Yep. If rates go down, prices go up, and vice versa. It's always the same. It's always the opposite direction of one another. Yeah. So, and if you think about it, all right, I have these future cash flows. My rates go down. I'm discounting those cash flows less, so my price is higher. That's what's going on there.
Okay. I'm gonna work through that in Excel, maybe.
Yeah, do it. No, that's how you got to do that. One day it'll just click in your mind. I'll guarantee it.
So thank you.
You're welcome. We'll see y'all later. See you, Enrique.
See you.
I guess I could stop recording.